Listen up, because what happened in gold and silver this week is the kind of move that rewrites people's beliefs in real time. For months, you've heard the same chorus. That was the top. It's over. It's just a blow-off. Get out while you can. And then the market does the one thing it loves to do: humiliate certainty. Gold and silver didn't just hold their ground. They pushed, they broke, and they printed fresh highs with the kind of momentum that forces even the loudest doubters to lower their voice. And here's the part most people still haven't processed. These weren't random spikes. This was follow-through. This was confirmation. This was the market saying, no, we're not finished. Now, quick favor, if you get value from this channel and you're tired of copycat channels recycling the same talking points, support me by subscribing and dropping OG John AG in the comments so I know you're really here. All right, back to the real story. Silver had one of those weeks that doesn't show up often on a long-term chart. Even after giving back some late week gains, it still put up a weekly move that reminds you why silver is not a boring metal. It's a coiled spring, and when it moves in a way that changes your planning horizon. Gold, meanwhile, is doing what gold does when the world gets messy. It climbs while people argue. It climbs while stocks still try to party. It climbs while central banks pretend everything is fine. It climbs while the average person is still distracted. And the S&P? It's up, sure, but the everything bubble doesn't look so heroic when the hard asset scoreboard starts changing. So today I want to do three things with you. First, I want to explain why the 2011 playbook people keep quoting is being misread, and why the conditions that created that peak are not the same conditions we're living in right now. Second, I want to walk you through how I think about realistic price zones using foreign currency benchmarking. Because if you only watch the US dollar chart, you're missing what the rest of the world has already lived through. Third, I want to end with the uncomfortable part. The rules around buying, selling, and moving money into metals can change faster than most people are psychologically prepared for. And when that happens, the price isn't the only obstacle. Access becomes the obstacle. Stay with me to the end because that last part is where the game board starts to tilt. Also, check the description after this video. There are bonus links waiting for you, including a premium WhatsApp channel link and a way to join the channel membership if you want the deeper stuff. Now let's jump in. Because this week didn't just feel strong, it did something very specific. It invalidated the clean little story that a lot of chart watchers had been selling you since late December. You remember that late December high? People called it a double top. They clipped the chart, drew the line, and then they spoke with that confidence that only exists when someone is looking backwards. The claim was simple. That's it. That's the ceiling. The bull run is done. But a real top doesn't behave like that. A real top is followed by weakness that shows up fast and shows up loudly. The air comes out, buyers disappear, volatility turns ugly, and most importantly, the market can't reclaim the high with authority. What we just saw was the opposite. We saw price tag the old high, hesitate just long enough to bait the "see I told you" crowd, and then rip through it anyway. That's not topping behavior, that's breakout behavior. And yes, the weekly close matters. Intraday spikes can lie to you. Weekly closes are where conviction shows up, because that's where the bigger money tends to set its footprints. Silver's weekly candle was one of those market on the calendar moments. When a metal can move that far in 5 sessions, it isn't doing it because a few retail buyers got excited. It's doing it because liquidity is thin and demand is persistent. Gold's candle mattered too, because gold has a habit of testing levels, breaking them, and then using them as support. That's the difference between a market that's exhausted and a market that's building a base for the next push. Now, I know some of you are thinking, okay, John, but what if this is just the final blow-off before it collapses? Fair question. That's why I keep using a simple time after the high test. When metals topped in the past, they didn't spend weeks politely hovering near the peak. They fell hard, and they did it quickly. That's what a peak looks like when the crowd is all in and there are no fresh buyers left. This time, instead of collapsing, we consolidated and then advanced again. That pattern matters. It suggests there are still buyers underneath this move. Real buyers. Buyers that don't show up for a one-day trade, but show up because they need exposure, they need inventory, or they need protection. And here's a detail most people miss. Silver and gold don't have to be popular to rise. They only need to be scarce relative to the demand that's trying to access them. Popularity comes later. Scarcity drives the early phase. Now let's talk about why the momentum part should keep you paying attention. Momentum is not just a buzzword. Momentum is the market's way of telling you that the path of least resistance has changed. It's the shift from every rally gets sold to every dip gets bought. And that shift is what turns a grind into a run. If you're watching this and you've been waiting for the perfect pullback, understand something. In strong markets, the perfect pullback often never arrives the way you imagined it. Instead, you get fast dips, higher lows, and then sudden breakouts that leave the sidelines behind. That's how bull markets punish hesitation. Now, another reason this move is so important is the relative story. When stocks are at or near record territory, people assume that's where the action is. But a record S&P doesn't automatically mean it's the best place to be. Sometimes it means it's the most crowded place to be. Meanwhile, metals can be doing something far more significant. They can be telling you that the currency unit you measure everything in is losing integrity. And if you think that sounds dramatic, just remember this. If your measuring stick is shrinking, everything else appears to grow. That's why comparing asset performance without thinking about the currency backdrop can lead you into false confidence. Now, here's the cliffhanger I want you to hold in your head as we move forward. What happens when this move stops being a metal story and becomes a policy story? Because the moment policymakers are forced to choose between protecting the currency and protecting the system, history shows they usually protect the system. And when they protect the system, the currency pays the bill. That's when metals can do things that seem irrational, until you realize they're just doing math. Keep that in mind as we go into the 2011 comparison, because the biggest mistake people make is thinking it happened before, so it must happen the same way again. Markets repeat themes, not scripts. The first thing you need to understand is why people keep yelling 2011 every time gold or silver makes a strong run. They remember the feeling. They remember the headlines. They remember the suddenness. They remember how confidence turned into panic in a matter of weeks. But memory is not analysis. 2011 wasn't just metals went up and then they went down. 2011 was a pressure cooker environment where fear, debt stress, and policy responses collided in a narrow window. Back then, the world had just been punched in the mouth by the financial crisis. People were still raw. Trust was still fragile. Governments were still improvising. And the bond market, especially in parts of Europe, was flashing warning lights that even non-experts could feel. That atmosphere matters, because tops don't happen in a vacuum. Tops happen when positioning gets extreme and when the crowd reaches the emotional peak, usually right when the policy environment is about to shift. So here's the question. Are we in that same panic peak moment right now? Not yet. And that's not me saying the world is safe. That's me saying the kind of synchronized fear that forces a blow-off top is still ahead of us, not behind us. In fact, the ingredients today are arguably worse, but the timing is different. Back then, there was still a perception that global cooperation could hold things together. There was still a belief that major powers would act as stabilizers, not rivals. Today, the tone is different. Today, the world feels more fractured. Trade is weaponized, supply chains are political, resource access is strategic, and the friendly globalization era has been replaced by a more competitive, more defensive era. That matters for metals, because gold and silver are not just commodities. They are trust meters. They are system confidence indicators. They are the scoreboard for policy credibility. And when credibility weakens, metals don't need permission to rise. Now, let's talk about the second big difference between 2011 and now. Interest rates. This is the part that gets ignored because it's not as exciting as a headline, but it matters more than most people realize. Major cycle tops in precious metals typically do not happen until the interest rate cycle has bottomed and begun to turn. The easy money phase creates the lift. The rates stop falling and start rising phase often marks the moment where the party changes. Right now, we're not in a world where rates have definitively bottomed and reversed higher. We're still in a world where rate cuts are openly discussed, priced, and expected. And as long as that remains the case, the "this must be the top" narrative is premature. Could we get violent pullbacks? Absolutely. Silver especially can drop like a rock, even in a bull market. That's part of what makes it so psychologically hard to hold. But a pullback is not the same thing as a cycle top. This is why you've heard me say before that if you zoom out, we're not living the end of the story. We're living the acceleration phase. If anything, the latest surge suggests we've moved deeper into the first big wave of this move, closer to the point where the public begins to notice, but still far from the point where the public fully participates. And that's the difference that matters. Because the most explosive phase usually comes after the "I guess it's real" phase, and before the "everyone can't stop talking about it" phase. Now, I want to shift to the benchmarking method because this is where people's minds start to stretch. Most investors in the US only evaluate gold and silver through the lens of the US dollar. But the US dollar is not the world. It's a major piece of the world, yes, but it's not the whole picture. Other countries have already watched their currencies weaken in ways that Americans are only beginning to experience. And when you price gold in those currencies, you see something important. The new highs story is already old news in many places. That's why benchmarking matters. When you compare gold's previous peak in one currency to its current level in that same currency, you can see how far along that country is in the currency debasement storyline. And when you do that across several currencies, you get a range, a window, of what a similar process could look like in the US if the same pressures play out. So what do we see? We see places where gold has not just made new highs, it has left the old highs behind. We see places where the previous peak is a distant memory. And then we look back at the US chart and realize the US is not leading. The US is catching up. That's not an insult. That's just how currency math works. If your currency loses purchasing power more slowly than others, your gold chart will look calmer for longer. But if your currency starts losing purchasing power faster, if policy loosens, if deficits widen, if confidence cracks, then the gold chart doesn't stay calm. It snaps. Now do the same exercise for silver, and the effect is even more dramatic because silver is more volatile and because it has a smaller market relative to capital flows. In several currencies, silver's old peaks have been surpassed by wide margins. In the US, it has surged, yes, but relative to the global benchmark, there is still room. And that room is what people underestimate. Here's where I want you to be careful. I'm not saying price only goes up in a straight line. It won't. Silver especially is going to test your conviction. What I am saying is that the structural forces that drive metals higher, debt, money creation, geopolitical tension, deglobalization, distrust, those forces are not solved. And because those forces are not solved, the probabilities favor higher highs over time. So let's talk zones. If gold is accelerating toward the kind of catch-up move we've seen elsewhere, you should mentally prepare for numbers that sound impossible to people who haven't run the math. A run toward the mid-thousands is not fantasy if the currency backdrop continues to weaken and if rates continue to drift lower. And for silver, moves beyond triple digits are not science fiction in a world where investment demand collides with industrial demand and where inventories are tighter than the average person believes. But I want to add an important psychological warning. When prices start approaching these levels, the narrative gets louder. The pressure increases. The temptation to chase increases. That's why having a plan matters before the crowd arrives. Because once everyone arrives, that's when you're most likely to make emotional decisions. Now, before we go into the access and controls section, I want to do something that will help this community. If you're one of the people who has actually benefited from holding metals, if you've stacked steadily, if you've taken profits smartly, if you've used the gains to reduce debt or build stability, I want you to share that in the comments. Not to brag, to show the newer viewers that discipline works. What's one lesson you learned the hard way that you wish you knew earlier? And second question, do you think the bigger opportunity over the next 12 months is in gold, silver, or the miners, and why? Drop those below. I read a lot more than you think. Before we get into the rules can change section, I want to address something that keeps popping up in my inbox and in your comments, the banking angle. Every time silver surges, people immediately ask, are the big players trapped? Are they short? Will they get rescued? Here's the way I look at it. Yes, in modern finance, rescues are normal. When banks get stressed, authorities invent facilities, create emergency backstops, and change accounting rules so the pain doesn't hit all at once. You've seen it before in different forms, and you'll see it again. But the bigger issue for you as a regular person isn't the behind-the-scenes chess match. It's the side effects. Because when rescues happen, they usually come with more currency creation, more guarantees, and more temporary programs that quietly become permanent habits. And that's fuel for metals. Now, on the positioning side, I want you to hold two ideas in your head at the same time. One, there have absolutely been periods where concentrated players leaned against silver and tried to control volatility. Two, in the real world, large institutions adapt. They shift, they hedge, they change exposure when the math changes. So instead of obsessing over one frozen narrative, watch behavior. When you see repeated smashdowns that fail to create lasting weakness, it often means strong hands are absorbing supply. Sometimes the hit is not to kill the move, but to get a better entry. And sometimes the market gives you a clue through chaos. Think about those moments when a major trading venue suddenly has an issue, a glitch, a delay, a technical problem. And right in that window, price does something extreme. Whether you call that coincidence or not, the practical lesson is the same. These markets can move violently when liquidity thins. Which brings me to the real constraint, physical availability. Paper claims can expand. Real metal cannot be printed. Industrial users don't care about your chart lines. They care about deliveries, lead times, and keeping factories running. When demand is steady and supply is tight, price becomes the rationing mechanism. And that's why silver, especially, can go from ignored to impossible faster than people expect. Now let me give you another cliffhanger. If the next phase is driven not just by investors but by procurement panic, by companies trying to secure supply, then the headlines will change, the premiums will change, and the conversation will change overnight. That's when you'll hear about delayed shipments, rationing, and suddenly higher minimum orders. And that's when people who waited for the perfect moment realized the perfect moment was earlier. So if you want to stay ahead of that, build your position while the process is still simple. And yes, if you want the deeper data and the more granular updates, that's exactly why we're building out the members-only research track with a separate team. So the people who want to go beyond the surface can do it without the noise. Okay, now that you understand why the banking drama is less important than the policy and supply consequences, we can talk about the part that hits you directly: access. One more thing before we move on, because this is where retention is won or lost. There are two kinds of people watching a metals rally: spectators and builders. Spectators refresh the price, feel emotions, and do nothing. Builders use a boring plan, ignore the noise, and slowly become hard to shake. If you're a builder, you already know this truth. The best buys rarely happen when you feel brave. They happen when you feel slightly uncomfortable. So here's my challenge to you. If you've been stacking consistently, tell the newer viewers what schedule worked for you. Weekly, monthly, dips only? What kept you disciplined? That one comment might keep someone from quitting at the worst possible time. If you're new, start with 1 ounce today and build from there calmly. Now, let's talk about the part people don't want to talk about. What happens when price stops being the only barrier and permission becomes the barrier? Because in the early stage of a bull market, your challenge is conviction. You're buying when people mock it. In the late stage, your challenge can become access. You're trying to buy when everyone wants it, when supply is tight, and when the system starts protecting itself. And yes, systems protect themselves. We learned that in banking crises. We learned that in market halts. We learned that in bailouts. We learned that in emergency programs with friendly names that hide harsh realities. When institutions are under stress, the rules get flexible for them and rigid for you. Now, people love to focus on the dramatic storyline. Banks are short, banks get crushed, government bails them out. That makes for an exciting movie plot. But the more practical risk isn't just a bailout. The practical risk is that institutions use policy, compliance, and risk management as reasons to slow the exit doors. And you don't have to imagine this. Versions of it already exist. Here's how it can look in real life. You try to move funds to buy metals, and suddenly your bank wants extra verification. They want delays. They want phone calls. They want forms. They claim they're protecting you from scams. Now, to be fair, scams do exist. There are bad actors everywhere. But blanket restrictions don't feel like protection. They feel like control. And if enough people start trying to move meaningful money out of the system and into physical assets, the system has an incentive to slow that down. Because money sitting in deposits is fuel for the banking machine. Money leaving is oxygen leaving the room. So do I think we'll see more friction? Yes. Not because anyone is evil in a comic book sense, but because institutions have incentives. Now, pause here because I need you to catch the subtlety. Most of the time, the system doesn't outright ban something. It doesn't need to. It just makes it inconvenient, expensive, bureaucratic, and psychologically annoying. That alone is enough to reduce participation. And once that stops working, there's another lever: taxation. Tax policy can be a soft ban. It keeps the market technically open, but it raises the cost of entry so high that the average person can't participate in size. You've already seen this concept in different forms around the world, where certain metals purchases come with added taxes or fees that push the real cost far above the spot price people quote online. And once a tax structure like that exists, it creates a weird effect. The secondary market can start pricing in scarcity and tax avoidance, meaning physical can trade at a premium that isn't just dealer markup. It's a structural premium. That's important because it means the person who got in earlier, before the friction, before the tax, before the controls, has an advantage that late buyers can't replicate. And this is where the conversation becomes uncomfortable, because it forces you to ask a simple question. If you believe you want exposure to metals, why wait until the system starts discouraging you? Now, I'm not telling anyone to go all in. I've never said that. Diversification exists for a reason. But I am saying that a small, steady, disciplined plan beats a panicked, last-minute decision. And the longer people wait, the more they risk one of two outcomes. They get priced out, or they get discouraged by friction and give up. And neither outcome helps you. Now let's add another layer: affordability. When silver was cheap in nominal terms, people could stack meaningful ounces without thinking too hard about it. They could build weight. But as silver rises, the number of ounces the average household can reasonably accumulate drops. That's just math. So the late stage of a bull market often becomes a game of smaller and smaller quantities for the average buyer. This is why early accumulation matters, not because you're trying to beat anyone, but because you're trying to beat the future version of yourself that will wish you acted when it was easier. Now I want to insert something creative here, because some of you have asked for inspiration. If you want silver-related success stories, real examples of how people built wealth, paid off debt, or used smart timing, there's a link in the description to a separate channel focused on those stories. So go subscribe over there too and see what's possible. All right, back to the main line. So where does this leave us? It leaves us in a market where price momentum is strong, where the macro backdrop is supportive, and where the psychological battle is shifting from, do I believe this, to, how do I stay consistent without getting emotional? That's the real challenge, because the market is going to try to manipulate your mood. If it pumps, you'll feel fear of missing out. If it dumps, you'll feel fear of being wrong. And if it chops sideways, you'll feel boredom and you'll want to quit. So you need a process. A process could be as simple as a weekly or monthly schedule, with adjustments based on your income and your risk tolerance. The point is to avoid the two deadly mistakes, chasing and panic selling. Now, here's the cliffhanger part, the thing most people don't see coming. The biggest moves in this cycle may not come from more people buying coins. They may come from capital rotation. Think about the bond market. Think about the trillions sitting in instruments that yield something on paper but lose purchasing power in reality. When real returns are negative, money looks for an escape route. And historically, when that escape route opens, gold tends to catch the first wave. Then silver tends to catch fire. Then miners and related equities can move in ways that make your head spin. And the public usually arrives late. So if you're watching this right now, you're earlier than you think. Now, I'm going to say something that will sound harsh, but it's true. A lot of people who support metals don't actually hold metals. They like the idea, they like the meme, they like the argument. But when it's time to act, they hesitate. And then, when price is higher, they complain it's too late. Don't be that person. If you want exposure, build it with discipline, not drama. And if you already have exposure, protect it with knowledge, not paranoia. Now, let's talk about the membership side for a second, because a lot of you have asked for deeper research. We're offering members-only videos where a separate team goes deeper. More data, more charts, more cross-checks, less fluff. If you want that premium research track, the join button and membership link are in the description. And remember those bonus links I mentioned earlier? They're there too, including the premium WhatsApp channel where we share updates in a more direct way. Now, one more community thing, because I want this channel to be more than just my voice. If you're successful, whether in metals, business, investing, or just getting your finances under control, share a quick version of your story in the comments. It helps other people stay focused. It helps people realize progress is possible. Even one sentence can shift someone's mindset. Now, let's address the big fear that always shows up when metals run. What if the authorities step in? People jump straight to confiscation stories or extreme scenarios. And yes, history has examples of ugly policy. But most of the time, the modern approach is less dramatic and more effective. Friction, reporting, taxes, limits, rules that sound reasonable individually but restrictive in combination. That's what you should watch. And you don't need to obsess over it every day. You just need to be aware that the environment can change and that being late can turn a simple purchase into a complicated process. Now, zoom out with me. Why are gold and silver doing this? It's not magic. It's not a conspiracy in the way people imagine. It's a set of incentives and consequences. When governments run persistent deficits, debt grows. When debt grows, the pressure to keep rates lower grows. When rates are kept lower than inflation, purchasing power erodes. When purchasing power erodes, people look for stores of value. Gold and silver sit at the center of that cycle. Add geopolitical risk, add resource competition, add supply constraints, add industrial demand, and you get a cocktail that keeps the metals bid. And that's what you're seeing now. Now, I want to be very clear. There will be pullbacks. There will be weeks where it feels like the move is over. There will be headlines screaming, crash. There will be experts on TV smiling while they tell you it's a bubble. That's part of the game. But the long-term trend follows the math. And the math right now does not favor fiat stability. So what should you do? First, if you're new, don't let the recent surge scare you. A bull market climbs a wall of worry. It doesn't wait for you to feel comfortable. Second, if you've been here, don't get reckless. Don't confuse a supportive trend with guaranteed straight-line gains. Third, keep your eyes on the policy environment, especially the direction of rates and the tone of central banking. When policy loosens, metals tend to breathe. When policy tightens aggressively, metals can pause or pull back. And right now, the direction is still toward easing. Now, I'm going to give you a retention-focused warning, because this is where people lose money even while being right. If silver runs hard, you will be tempted to make decisions too fast. You will be tempted to sell everything at once. Or you will be tempted to buy aggressively at the peak because you don't want to be left behind. Instead, decide your framework now. Are you stacking for protection? Are you trading for profit? Are you doing a mix? If you're stacking for protection, the goal isn't to time every wiggle. The goal is to build a position that makes you sleep better. If you're trading, the goal is to manage risk and not marry your thesis. And if you're mixing, then split your stack mentally. A core you don't touch and a portion you manage. That simple mental separation prevents a lot of regret. Now, cliffhanger number 2. As prices rise, the conversation shifts from should I buy to what can I even afford? And that's why I keep emphasizing ounces. In the early days, you can add weight. In the later days, you add fractions. So don't underestimate the value of starting sooner. Now, let me land this with a practical, grounded message. If gold and silver continue higher, it will not be because everyone suddenly became a metals nerd. It will be because the system is leaking confidence, and metals are the universal language of I don't trust this. If that's the environment we're moving into, you want to be positioned before the crowd, and you want to be positioned before the friction. So here's your simple action plan. 1. Subscribe if you haven't. Seriously, just hit subscribe so you don't miss the next update. 2. Check the description for the bonus links, including the premium WhatsApp channel and the membership option. 3. If you support the original work here, drop OG John AG in the comments so I can see the real community. And 4. Answer those questions. Gold, silver, or miners in the next 12 months? And what lesson would you give a new stacker today? Because the comments section isn't just engagement, it's a record. It's a signal. It's a way to help each other think clearly while the market tries to mess with our emotions. With that said, take care of yourself, take care of your people, and I'll see you in the next one.